Thursday Night Stock Charts Live. What we're going to talk about tonight is not a bunch of good stuff, honestly. I was prepping for the show. You always want to have something happy to talk about, but there isn't much in terms of what I'm seeing on the horizon in terms of equity prices that excites me in the least. In fact, after yesterday's Fed announcement, I made no uncertain terms a message to members that I fully expected lower lows. We got them today, and I don't think that we are anywhere near a bottom on this market. I think that taking out the June lows, whether it be this week, next month, is a foregone conclusion. We're going to talk about where I think the Dow Jones Industrial Average in particular is headed, because we're going to go over a yearly chart. When was the last time we went over a yearly chart of the Dow Jones or any other chart? That's why you tune in here to get a different perspective on the market from a technical view and also from a macroeconomic perspective, not necessarily a fundamental perspective, because we don't sit in the boardrooms and we don't know in reality what's going on in there. So we rely upon the charts. We rely upon the data coming out to help guide us in the right direction, and it usually works out well. You'll remember I've been saying that since April of 2021, we have been net neutral, meaning selling premium on the market. Honestly, directionally, we don't really care where stocks go, up, down, sideways, it doesn't matter. So we're selling premium. So that strategy is going to remain in effect. The only directional trades that we're putting on right now are commodity trades, gold mining stocks, gold, bought more physical gold this week. So what else we're going to talk about of the valuations of the market? We're going to talk about the Fed's balance sheet. Did it rise this past week, or did we see a decline in the Fed's balance sheet? And we'll go over some news items that are concerning about the market. So let's go to comments as people pile in here, allowing them a chance to settle in. Seymour Rivers. Great to have you, pal. Bob Cook. Franklin, hello, sir. The audio is good. Very good. Thank you. You know, I got lucky right before I spoke an utterance of a word. I checked to see whether or not this light was flashing. That's a sign that I'm on mute. It was flashing, and I caught it all by myself. That's the first time ever. Talon. Hey, Bobby Franklin. Hey, Seymour. Talon. Louis. Good evening to you, sir. Talon's enjoying a fine Romeo and Juliet. Enjoy that, Talon. Hey, Tim. Great to have you. All right. All right, so let's get to it. Again, folks, this is not going to be a rainbows, unicorns, and pixie dust broadcast. It's just not going to be. There's zero to be optimistic about, unless, of course, you're neutral or short the market. So let's get to it. We're going to go over the weekly charts as well. One trading day left to go. A lot can happen. So we're not drawing a conclusion of how the week is going to close out, because one trading day matters, but it gives us an idea of which way we are headed. We're going to go over to seasonality as well, at least for the Dow Jones Industrial Average, using TrendSpider, 35% discount code below. Take advantage of it. Cheapest price on the web, I will add. Let's get to it. All right, so we all know that yesterday the Federal Reserve raised interest rates by 75 basis points for the second time in a row. This is a pretty aggressive rate hike. I believe it's the most aggressive rate hike series that we've ever seen. The problem is that we've never seen the economy drop so precipitously. And I'm going to go to a couple of articles in a moment. So the Federal Reserve, Jay Powell, threw zero meat to the market in terms of pivot. Forget about pivot for now anyway. It's going to take an event. Folks, he had the opportunity yesterday, and this was the only bit of hope that I had, is that the administration would grab a hold of him, say, listen, this is your last Fed meeting prior to the election, where we have a meeting held within this quarter, meaning 401k statements are going out in a few short days. They had the opportunity to grab him by the scruff of his neck and say, listen, throw the market some meat, cause a rally, get those 401ks up, no matter what inflation is going to be here one way or the other after Election Day. We'll worry about it then. It didn't happen. So that tells me that he's going to wait for an event, a binary event, a crushing event to occur, and that's when he's going to finally pivot. I don't see it right now. All I do see is the prelude for a continuation move lower on this market. So how do we know that? How do we draw that conclusion? It's pretty simple. All right, so on a forward-looking basis, we had the Federal Reserve that plans on raising interest rates. Do they have a forecast? Yeah, so they changed this. We had been rolling over on forward-looking expectations of Fed rate hikes. That has now resumed upward, and expectations for a rate cut has now dropped. Is this right? Is it wrong? Well, since July, it's been pretty spot on, but it's a short time frame. So in the long term, all the market cares about is current expectations, and the expectation is rates are going up higher. And when we take a look at the rate hike odds, September was above 75%. Right now, you have odds of a November rate hike. I think this is going to get up of it around 50 basis points, half point. If I'm reading this right, I think I am. If we get 50 basis points, the markets will rally. If we do not, yields are going, the markets are going lower. Add to this, the Federal Reserve jawboning the market lower. Stocks are still expensive. They're still expensive. You have a 28 handle on the Shiller PE ratio. Mean is around 17. So this is a stock market that is still very, very expensive. What brought us to the party? What brought us to the bull market post-COVID? Well, it's simple. Here's the Fed's balance sheet going back max view. Here's COVID. Here's their balance sheet. It just ballooned. What happened during that ballooning period? All that free money sloshing around the globe? Equities went through the roof. That's the primary cause of the market over the past 2.5 years. It's undeniable. It's fact. It's in the books. So where's the Fed's balance sheet going, and what does it mean? Well, we'll go to the first question second. But what does it mean is the inverse of this chart. Right? If we're rolling over, as you can see here on the Federal Reserve's balance sheet, you need to expect that what brought us to the party, which was cheap money, is now leaving. So who's going to keep the party going? Economic growth? I don't think so. A free market? I don't think so. Yearly chart. Last week, we broke two new 52-week lows on the Fed's balance sheet. So the trend continues to be lower highs and lower lows on the Federal Reserve's balance sheet. This is not good. And they still haven't fulfilled their promise to unload billions more of what they were supposed to do onto the market. Who's going to buy it? Let's talk about seasonality for a moment. This is TrendSpider. Again, 35% discount code below. Their seasonality data. Dow Jones going back 11 years for the months of August and September, rough months. September, the worst month of, second worst month, on par for the worst month. January and September being tied. October over the past 11 years is up 60%. So where are we now in terms of a weekly seasonality? We're right here. We're week 39. Going back the past 11 years, we're up 27% of the times. Going into next week, we begin to see a trend that carries us through to the year end, but there's blips in here as well. I'm not sure what month this is, November, probably November, where you have below average weeks, but you see some really consistent, strong up weeks in the back half of the year. So we have to get through this week and next, and then we'll maybe see some stabilization of the market. Now, let's talk about the technicals. Let's say hello to people. Oleg. Hello, sir. TZ Burton, hello. Yoga Mac. The High Contrarian family, love that. About to throw some CA tri-tips on in a minute. Nice. That Fred chart looks, yeah, it's scary. It's really, I'll share this out. It's bananas, man. See, where gold and silver seem resilient despite the high Dixie. I'm going to go over the dollar in some detail. Yeah, I bought some gold this week. I think that we are probing a low. Doesn't mean it's not going to go down a little bit further. I'm not making a definite bottom call here. I've been very critical of gold over these past couple of months, but I'm less critical this week than I was last week by quantum leaps, more optimistic. But the dollar is still strong. It did spike up yesterday, remains strong today despite the Japanese yen or the Bank of Japan intervening to try to prop up the Japanese yen. We'll go to a chart of that in a moment. But the Dow Jones, and this is the chart I really wanted to share with everybody, and it doesn't mean that we're going to close out the year looking this way. We're going to drill back down to a quarterly chart. But I wanted to take a look at a 100-year view of the Dow Jones Industrial Average just to get a feel for where we're at on a macro, big macro basis. And what we're doing here, and for those folks not familiar with candlestick charting and the terminology I'll be using, this is a bearish engulfing bar. There's a link below, 5-part video tutorial, my top 5 favorite candlesticks patterns, free. Take advantage of it. So this is a bearish engulfing, also known as an outside reversal bar, meaning we put it in a new yearly higher high. Great to see. That's bullish stuff. The problem is we've also taken out the lows of last year, and we're currently trading down below it. Now, we could rally back into the back half of December. Seasonally, it's highly probable that we will. But if we do not, this sets the stage for a continuation breakdown going into 2023. So I wish that I could stop there. Look at the volume already. Look at the down volume already on the year. We have a full quarter to go before the year is over. And look at this down volume bar. So when we drill down to a quarterly view, you know, things are, I haven't updated this in a very, very long time. As you can see here. This is when we were, the last time I updated this, when we were probing a top back in 2020. I was pointing out the lower volumes. That's why I love annotating my charts and looking back on them. It's been a long time since I touched this chart. So let's update it. So we need to take our crayon out and say, okay, what's going on here? Well, we have a downtrend channel on RSI. We broke down. This is 2020. Rallied back, lower high. Now we're rolling back over again. In all probability, we're going to probe back down to this lower band of support. Now, you would think that with all the damage done in the equity markets in 2022, that you would look at this chart and you'd say, wow, we got to be near a low here. We got to be near the low. I mean, we've been in the bear market for over a year now. Well, that's not what this chart is telling us. And you could divine by this chart that, oh, the lovely Trish, welcome Trish. You could divine by this chart that what we have here is the beginning of a downtrend channel with a price target on the Dow Jones Industrial Average at the midpoint. What I'm doing here right now is I'm just connecting prior lows. That's it. Simple as that. So this is a surefire way to draw your support levels, because you're always going to revert to the prior lower band of support. If it holds, great. If it doesn't, well, then you look for your next support level. So let's upload this and divine. Look at the volume. Divine where our support MACD has gone negative on a quarterly time frame. Now, let's upload it. $23,187 in that ballpark, give or take a couple of 100 points. But to put that into perspective, we closed out the day at just over 30,000. So we're looking at a measurable drop, a 7,000 point continuation move lower on the Dow Jones Industrial Average. And that would help resolve this problem. And this is not an actual picture of where earnings are going to be. I'll give you a case in point. Let's bring up consumer discretionary names. Now, consumer discretionary names, Target, Walmart. Wall Street, if you're using forward-looking PE multiples to help divine how expensive a market it is, well, here's a wake-up call. The Wall Street analysts, for what they're worth, I don't use them for anything else except to mock and ridicule. The Wall Street analysts have forward-looking guidance on the consumer discretionary names up 16, either 14 or 16%, double digits. Double digits. They have not ratcheted down their expectations on a forward-looking basis. So, you look at this chart and you'd say, you know what, there's got to be a low here. No, there doesn't need to be a low. This is a broken chart. The discretionary names are getting hammered. Here's a yearly view. Why are the discretionary names getting hammered? It's simple. Money is being spent at the gasoline station. It's being spent on energy. It's being spent at the supermarket on consumer staples. So the discretionary names have yet to have their forward-looking guidance revised measurably lower, folks. So in terms of earnings trades next quarter or this coming quarter, which is coming up soon, I don't know how many earnings trades I'm going to be doing if they do not really correct this market and correct this market hard. If they correct the market hard, we'll do earnings trades. If it's just lethargic and we just trade sideways with a bias to the downside into, especially to the upside, into the new quarter, we're gonna pass on doing earnings trades, because you run the risk of a binary event. So that's the story on the Dow Jones. Now, other things out there that are disturbing, to say the least, is that you now have Russia now restricting travel for young men for partial mobilization. They are going to ramp up. They're going to annex those western territories or eastern territories of the Ukraine. It's going to happen. I've been saying that that's what's going to happen. They're going to claim victory and then they're going to go home. The problem is that we're not going to let them go home. And they've come out and said that they're going to consider these new territories states of Russia. And if we cross into them, that it could be nuclear conflict, regional. I don't know. Uh, if the Russians launch nuclear weapons into Ukraine, they run the risk of blowback into Russia. I mean, it's right next door. So this is scary stuff that's building up. They have not used heavy bombers. They've used limited hypersonic weaponry in the Ukraine. So I think that they're going to take this up to the next level, and it's going to get worse before it gets better. What happens over here is a cataclysmic potential event. And what we have are we have a president and an administration, and this is not just to knock the Democrats. We have a silent rhino Republican Party that they're complicit in crimes against the American people, not to mention a lot of other people across the globe, in particular the Ukrainian people. And you have a president that, if you can believe that he's in charge, which I do not, inflation rate month to month was just an inch, hardly at all, Biden said in response to a question by CES. He was on 60 Minutes the other night. This is an administration that now redefines words that they don't like because it doesn't suit their narrative. So when you're dealing with delusion like this, the refusal to deal with reality, that's a major problem. That's a freight train. Right now, that we're looking down a black tunnel, and we know, like a cartoon from many, many years ago, we know that train light, which is growing quickly and coming towards us, is growing more and more rapidly. And we are on the train tracks, and something's going to have to break here. There are way too many plates in the sky, whether it be Russia, whether it be Syria, whether it be Iran, whether it be Israel and Iran, whether it be the fact that the U.S. Housing market is beginning to contract dramatically, and you're going to see home prices drop enough so that people could gain mortgages so they could afford new housing. Where that equilibrium is going to be, I have no idea. But that lack of a wealth effect by the American consumer is only going to cause them to hold on to their money and not spend. We're also looking at a problem. U.S. gasoline pump price end record losing streak as SPR, Strategic Petroleum Reserves, drain looms. Okay, so what the administration has done is that they have drained to levels not seen since 1985 the Strategic Petroleum Reserve, and they're probably going to take it lower. But the problem is what do we do after those reserves are gone? How do we keep a lid on oil? Except for the fact that you have a Federal Reserve that's trying to kill demand. But we're also trying to kill production here in the United States. So by not allowing for new leases for the oil companies to drill. So oil is still contracting, but we run the risk of a reversal on these names in the coming weeks as the economy continues to slow. And how do we know that the economy is slowing? Well, you take a look at the port of LA. Remember, a year ago this time, the port of LA had ships backed up as far as the eye could see, waiting to unload goods and bring them into the United States. Now there are roughly on average 6 ships unloading per day. Yeah, here. As of September the 21st, there were 132 cargo ships of Los Angeles and Long Beach. Dozens of container ships were anchored or adrift off the coast. As of August the 30th, 2022, that number has dwindled down to only 8 ships waiting off of Southern California. The end of backing up in the ports on the West Coast is a sign that we are moving on. Danielle DiMartino Booth, who happens to be very good. She's an economist. She worked at the Federal Reserve, very smart. She's got a newsletter called The Quill. She's very, very good. Danielle DiMartino Booth recently stated, We have never seen the collapse of the magnitude that we are witnessing in imports. That is always a telltale sign that you are already looking through the rearview mirror at recession. We already know this, right? They changed the definition of recession. Doesn't mean that we're not in recession. We're in recession. And to validate that Danielle is on point here and that we do have a slowdown of shipping, look no further than the fall in container spot prices. I think it was last year. These are going for $20,000. Yeah, they've fallen 76% over the past six months. So we're clearly seeing a sign of a global contraction here. Now, this is going to come in handy when we talk about the dollar in a moment, because the dollar still remains the currency of the globe. 60% of all transactions are conducted in US dollars. And the reason why, this is kind of a misleading headline here. I don't totally agree with this. Central bankers are gaslighting us about the strong dollar. And the conclusion is this, and I've spoken about this before, is that the dollar is the least dirty shirt in the bin. Simple as that. Such talk must be heartily opposed, of course, as the dollar is not too strong. Rather, talk of the dollar's strength is not really about the dollar at all. True. It's all about the weakness of other currencies, and it's about the other central banks have embraced monetary policy that's even worse than the US's Fed. Very, very true. But we also need to keep in mind that the dollar underpins a derivatives market that is in the dollar amount of 1 quadrillion. That's $1,000 trillion. I think it is $1,000 trillion. And that's the derivatives market. That eclipses the size of the bond market and the stock market, I believe, combined. So it's essential. This is why there's such a demand for US dollars, is to keep the derivatives market afloat. The problem is that if something cracks and you lose a bit of confidence in the derivatives market, well, a derivative is a bet on a bet on a bet on a bet. So nobody knows truly at these banks what's in these things, but except for the analysts that cover them. So we have to worry about a lot of plates being spun by useless idiots that, if one goes, this whole thing gets real fast. And I'll reflect back on this chart here, and that we really haven't even begun to correct in this market. This has been an extremely orderly sell-off on the Dow Jones and on the S&P relative. I got to put it into context. If you haven't traded in 2000, if you haven't traded in 2007, 2008, if you haven't traded in February of 2000, then you won't appreciate the context. Those were crashes. This is not a crash yet. And it may never be. It may be a death by 1,000 cuts. So we've only just begun to decline here on the equity market. So where to from here? If the dollar is the least dirty shirt in the room, is there any reason whatsoever to buy gold? Because gold, let's face it, has not been the trade to be in the past 6 months. It's been horrible. So why is the price of gold so weak in an inflationary environment? It's simple, folks. It's very, very simple. The gold is an inverse partner relative to the US dollar. All right, so over here on top here in gray is the correlation of gold versus the dollar. they trade inversely 79% of the times. That's a huge inverse correlation. That's on a daily basis. You go back, I don't even know if this is going to be better or worse, but let's check it out. It's better. But there's an inverse correlation nonetheless on the dollar versus gold. And lately, that correlation, that inverse correlation, has been dramatic to say the least. And you can see here, you had a very tight correlation back here. This was in January into February. Why did this happen? The reason why it happened is that you had Russia invade the Ukraine. They will trade in tandem, meaning gold and the US dollar when there's geopolitical risk. You have that potential over in Russia still. It's the value of that has come out of gold, but the threat is still there. Now, how are we doing in terms of price action with the strong dollar on a daily time frame on gold? Not too bad. Gold has stopped going down. I'm not calling a bottom here because we still have a lot of resistance above at that 1700 mark, but it looks as though we are forming a base. Whereas you take a look at the US dollar, I did not want to do that. I closed out my charts. You take a look at the US dollar and you ask yourself, okay, it's the least dirty shirt in the bin. It's extremely strong. What could send it lower? Look no further than the Bank of Japan. The Bank of Japan intervened in the currency market. You got to understand, the Japanese central bank can't raise interest rates. They're way too over indebted. They can't do it. But what they can do is manipulate the yen. So they're not going to be very aggressive here because they like the weaker yen because their exports become cheaper. So the Japanese yen is doing what they can to try to bring the dollar down, strengthen the yen. And how did that work out today on the Japanese yen? Pretty good. We're up on the week. Now, the euro is a basket case on the week. I thought we were done going down, but apparently not. And the reason why I thought that we were done going down is that the EU raised interest rates for the first time in over 10 years. I think it was last week. But that rally, or the week before last, that rally did not last, obviously, because now we've taken out the lows. We're 52-week, we're at multi-year lows, if not historical lows on the FXE. Yeah. But we are nearing very oversold levels on the euro. And while I want to point out a bit of a divergence here, at current, this being Thursday, one trading day left to go, a lot can happen, right? We could rally back. We could close at new all-time highs tomorrow. I don't know. But we have broken down below weekly support, taking out the lows of the year. What is RSI doing? It's not confirming. It's holding support. It's holding support. Volume is heavy. I think that we're considerably closer to a bottom on the euro than we are anywhere near a massive move up higher on the dollar. Might we get a capitulation blow off top on the dollar? I think if we do, that'll be it. But I think we're very, very close to a top in the US dollar. Why? It goes back to that statement. We're the least dirty shirt in the bin. Yet now you have the Japanese moving in. They are manipulating their currency. That's helping the yen. That's the second largest component of the Dixie basket relative to the dollar, the euro being the first. The Europeans, well, the EU, I should say, is now raising interest rates. I believe Switzerland is raising interest rates. So we're not the only game in town anymore. And frankly, the stronger dollar is causing much greater inflation over in the Eurozone. And that's causing them a massive problem because there are already shortages of oil and gas. It's very expensive. And as the dollar rises, oil and gas becomes all the more expensive because, let's face it, they're traded in US dollars. So they have to trade in their euros for more expensive dollars to go out into the marketplace and buy oil and gas. Unless they're buying it from China, where they don't need the dollars anymore. So the dollar looking strong on the week. Daily chart, no new higher high. We're a bit extended here relative to the 3 standard deviation Bollinger Band. I think we're pulling back soon. I want to see how we closed out the day today. We closed pretty bullish on the session. We sold off hard on the Japanese yen getting manipulated, but we bounced right back as the euro took a nosedive. I don't know what that's all about. Larry, don't be fooled by the low-key demeanor of Jay Powell. He's a riverboat gambler. He's all about cards up his sleeve and surprises. Agreed. He's an attorney. We need peace. Republicans are the new anti-gov hippies. Yeah, isn't that crazy? That is where Danielle went. Yeah. Yeah, she's got a good YouTube channel. She's pretty good. What the hell I do with my lid? I forget about it. Yeah, she's very, very good. She's all over YouTube. All right, let's get to it. So the dollar may pop up higher tomorrow. See how the euro closed out. Higher lows. Not bad. Not bad. Let's see how the yen closed out today. Here's that big gap up. We absorbed the pullback, held support. Looks like we have a higher low being put in on the Japanese yen. This is very critical because it all goes back to why gold is down. The price of gold is down for one reason only: the strong US dollar. If you go back in time and you take a look at gold back in the 1970s and into the 80s, if you're interested, I'll show you. If I have it up here. I know I had it. I don't want to waste your time. It's a good chart I developed. All right, I'm not going to waste your time. It just shows you how back in the 70s, yields went up, gold went up, stocks went down to flat, dollar went down. That's the difference between now and then. Yields are going up, gold's going down, but the dollar's going up. It's the dollar that's causing all this. Or I shouldn't say all this. It's causing the pressure on gold. Now, I've been mentioning to members that this chart here is by far the most concerning chart I have on my list, and it's the VIX. And the VIX, I've been pointing out this long, big base that we've been building. We had this congestion area here that lasted for several weeks, but that all came to an end the week of August the 22nd when we broke out, and we broke out in a very, very big way. Now, this week, we finally broke through to hit a 30 handle for the first time since June. But it looks as though the breakout that we saw last week above resistance and retested this week may in fact hold, unless, of course, equity markets open lower tomorrow and then rally to close positive. I'm not going to say it's not possible. It's improbable, but it's possible because the Dow Jones managed to go green like at around 3 o'clock. It spent a few minutes there. Then it went back red again, closing down about a third of a percentage point. So it's possible. I'm not going to say it's impossible. So we have a breakout on a weekly chart on RSI. And this has really got me focused on this because we didn't break out this week. We broke out last week. So this is a continuation move on the RSI. All that we're missing now is a confirmation move up higher on the VIX. Daily view. Now, here's what makes me somewhat optimistic about tomorrow. They were selling the VIX today. VIX came out of the market. Volatility came out of the market today. Not that it was reflecting my options positions, but volatility did come out of the market today when you had the S&P 500 trading down by over 0.75 of a percentage point. VIX traded down today. Talon, I'll check it out later. I don't know what you posted, so I don't want to put it on air. So this could be a positive setup for tomorrow. The daily chart I'm not really bullish on the VIX. The weekly chart I am bullish on. Now, here's where things get real. And it's the Dow transports. We all know about the FedEx news from last week. We spoke about it last Thursday night. Where's FedEx now? It is just cratering. Back to the transports. So the transports are now at lows not seen since February of 2021. And in all probability, we are going lower on the Dow transports. Why is this important? It's important because the Dow transports I consider to be our canary in the coal mine for equities. We spoke earlier about the containers, the container rental rates for dry bulk shipping, for shipping, container shipping. They're cratering. They're down like 65-70% in the past 6 months. So the transports are under a lot of pressure. We know that from FedEx right out of the horse's mouth. They removed forward-looking guidance. When a company removes forward-looking guidance, you got to get worried. So it looks as though the transports are going to move lower. That'll drag down everything else. We spoke about the Dow. We're going to skip the Dow. We're going to go to the Qs. This is technology laden. We know that there is above a 3 handle on the 10-year yield. There's an inverse relationship between technology and the 10-year yield. Yields move up higher. Technology goes lower. What are the yields doing this week? Big move up higher. We're going to a 4 handle on the 10-year yield. So we moved up higher, over 7.5% increase on yields in 1 week. Qs down over 3% on the week. Now, if you want to break it down and take a look at individual sectors, banks. If there's one sector that should do well in a rising interest rate environment, it's the banks. But they're not. They're breaking down. A massive breakdown on the banks. 1 trading day left to go. Volume light. We'll blow through these. What time do we have here? We have about 15 minutes. I want to do some chart requests. Folks, if you want any charts, for me to go over any charts, please enter them in the chat box. Technology. Bearish key reversal bar on the week. No great shock. We're coming down here, probably to the June lows. I think we break the June lows. We may put up a defense first, to be fair, but I think that ultimately we break. Moving on. I'm in the members area looking at requests. Okay, we got a couple. Let's take a look at the semis. The semis are just, I mean, if there's any indication, let's do this. Let's do this. I'm going to overlay the 10-year yield behind. We'll make it red. Behind the price of the semis. Look at the inverse relationship. Here's the 10-year yield ripping up higher. What is the semiconductor sector doing? Taking a nosedive. So it's clear that you have a severe inverse relationship between rising yields and semiconductors technology stock. So if you're thinking that we're going to get a substantial rally in technology stocks, and we've seen the bottom, no, they need to go through, Jesus Christ, they got to fire people. They got to revamp their operations. They're going to focus on margins. There's a whole lot of pain to come before these semiconductor companies can show fat margins. That's how they're measured, fat margins on their earnings reports with a yield above 3%, 4%. Even biotech is being taken out to the woodshed. This is a leveraged ETF, so keep this in mind. 3 times leveraged ETF, down 18%. You got it, Frank, of course. Consumer discretionaries, we went over this. Basket case. I mean, energy, not horrible, but they're certainly coming for the generals here, taking them down. What are we down on the week? Just about 2.5%. Crude oil prices down on the week. They broke support. I don't know why I have this up here twice. Gasoline prices. This is a problem. This is a problem. Remember that article I went over earlier that the proximate cause of as to why you're seeing weaker oil and gasoline prices is you have the Biden administration putting the country at risk, dumping our strategic petroleum reserves to buy votes. But guess what? We're flirting with a weekly breakout on gasoline prices because the market's going to begin to price in a couple of things. What might that be? Glad you asked. They're going to price in refilling the SPR. They floated that the other day. They had to retract it because they look so stupid. They're also going to have to, I just lost my train of thought. Damn. I lost my train of thought. Sorry about that. Brain fart. What was my second point? It's going to drive me crazy now. I'll come back to it if I remember it. All right, so we have a potential breakout on a weekly time frame. And the other point I wanted to make, if we do get a pullback in the US dollar, guess what happens to oil prices? What is oil priced in? US dollars. If the dollar goes down, oil prices right back up. Gold. Kind of went over this. Holding weekly support. We went over the daily chart. We didn't go over the weekly chart. Stokes is still declining down below 20. Rallies tend to fade. And we've seen that. I use that phrase all the time. But nine times out of 10, it's an accurate statement because it's just spot on. Weak Stokes down below 20. Rallies tend to fade. But one thing that we've stopped doing here is we've stopped going down. Yes, we're down on the week, but we're off the lows of the week. And we may have tested last week's lows, but I don't think we broke them. Maybe we did. Low 1661.30. We did. We traded slightly down below last week's lows on the price of gold before rebounding. So that's the market in a nutshell, folks. I would love to be challenged for my bearishness on this market, a reason as to why we should be bullish. and we could talk about it. I really would be open to it. But I'm not here to blow smoke up anybody's, you know what. It's all about the charts. It's all about the data. And there's just nothing for me to want to buy this market right now. You know, as a swing trade, sure, there'll be an opportunity. But right now, no. Let's do some chart requests. Okay. You know, I want to go back to something. I rarely agree with Jim Cramer on anything, but there always is a bull market somewhere. It's true. That bull market could be in inverse ETFs against the S&P 500 Qs, whatever you want to short. It could be the price of gold, which appears to be bottoming out as the dollar is probing a top, because now we have global participation trying to bring the dollar down, whether it's the global trade declining. 60% of all global transactions are traded in US dollars. If you get less transactions, there's less demand for US dollars. If you have China and Russia now trading with other BRIC nations, which make up 3/4 of the globe's population, and they're not using US dollars anymore, or they've stopped using them for oil trades, well, that takes a bite out of the US dollar. If you have the Japanese, Bank of Japan moving in, propping up the Japanese yen, that's bearish for the dollar. If you have the Eurozone raising interest rates, guess what? That's bearish for the dollar. So while the chart of the dollar is very, very strong, it's always brightest before the capitulation, the sell-off. And it's just as always darkest before the dawn. It's the inverse. So I think that we're setting up for a dollar top here, short term at least, and a rally in gold in the minors. Let's talk about some chart requests. I have a couple in the members area. This one I do not know. Let me copy and paste it. Larry, I have two from you, PNRG, and this one here. This is an ADR. Allianz. I believe it's a German company. German or Swiss? Monthly chart. Couple of trading days left to go here in the month. Few trading days, I should say. We've reversed off the lows of the month. We have another week to go. This is interesting. These are automated trend line, folks. If you're not familiar with automated technology for your charts, TrendSpider, 35% discount code below. So I'm going to bring those automated trend lines back up. And you have the potential for a weekly retest here on Allianz. We broke out last week above resistance. And this week we're retesting. One trading day left to go. We're right at support at current. You want to see an update tomorrow to validate this retest, but it's looking good on a weekly time frame. On the day, we faded off the highs of the session, closing down. I think it's firming up here. I would wait to the end of business tomorrow to see whether or not we close above weekly support. I'll share this out with you. That chart is in the box. Oleg, so much value. You're very welcome, sir. Thank you for being here. Appreciate your time. Thank you for the comment as well. So Allianz looking good. The other one for Larry, PNRG. Prime Energy Resources. Energy's under a little bit of pressure here. I would say avoid this one, Larry. I think we went over this one not too long ago, and this is the one that's at resistance. It remains at resistance. I would avoid this one. It is not a short, but I would not buy it at current. Bearish key reversal bar on the week. That would be the third consecutive one. No, you got to avoid this one. Again, the automated trend lines, huge time saver. TrendSpider below. Take it off. You got to avoid. We broke down today. They may rally this back in an effort to try to recapture and close back above. Let's call it $89 per share. I think it fails. I think it moves lower. Now, if I'm wrong and it closes back above $90 per share, then it's a game changer, and this could be a buy. What kind of volume do we have? Oh, this is very, very thin volume here. Very, very thin volume. Traded only 40,000 shares today. I mean, this could have been one dump. So I would definitely not short it. But you never know with these names. They could gap it right back up on that kind of volume. So it's very, very volatile. All right, we got, I think it was AMT for Franklin. American Tower. We haven't gone over this one in a while. Monthly chart. Yeah, we have a bear flag set up here, Franklin. And there you have it. That bear flag setup has been resolved, and it's been resolved to the downside. So this is going lower. Weekly chart. This has been in a very tight trading range. Yeah, this is going lower. If you're looking for a price target on AMT, it's down at around 225. That's where the algorithm's picking up a support level below. Daily view. Daily chart. Not a bad day. It's been under pressure. It looks as though we had a bit of a resolution day. I would see whether or not we trade sideways tomorrow. Do we put in a new daily low? If we do put in a new daily low, I would avoid. If you're looking for a quick swing trade here, I could see one setting up, but it needs to trade sideways. And, of course, take your crayon out. Draw your resistance level. Buy the breakout. Sell the failure. There's your downtrend channel. I'll share this out. But the higher level view charts, this is not investment worthy at this time. Do you have a price target from the video? Yeah, in the video. I love the company. I really do. I hate saying anything negative about it. So what I do when I'm asked a question, or if I have the question myself, Tim, is I won't use the daily charts. Rarely will I use the weekly charts. I'll go to the monthly charts, because what they do is that view provides a smoothing mechanism, and you get a lot more data to identify where you may have buyers of like mind willing to step into the breach with you to shore up a stock share price. So let's do that. We'll begin with the monthly chart, and goddamn, we have really broken support here in a very bad way. I can't believe I'm about to say this. I think there's a very good chance that 115 gets tested and that it probably fails. This price target I'm about to give you assumes higher yields, or yields above 3.5%. If yields drop down below 3.5%, then I might retract this call. But if yields remain at their current level or higher, I think that we're heading down here to $87 a share. If you ever want to see a chart and overlay the 10-year yield to realize just how adversely impacted technology stocks are relative to the 10-year yield, look no further than the video or the SMH. We've already gone over. If you're just joining in now, go back a few minutes and take a look at the inverse correlation. I mean, this is a train wreck. And now you have the federal government threatening to cut off chips to China made by NVIDIA. So, I mean, I think that this right now is kind of, I can't believe I'm saying this. One of my favorite stocks is, to me, kind of uninvestable because of the unknown of what the Biden administration is going to do. And I'm not even saying they're wrong, to be honest with you. If there's one thing that they may be right about, is cutting off the export of these chips to China. They are our enemy, after all. But I don't think they're doing it for the right reason. I don't trust them at all. So, yeah, $87 a share. If we break 115, that's where we're going. But I'll tell you one thing. I want to be a buyer down at that level. We want to keep this active for a good long time. There we have it. Weekly view, bearish key reversal bar on the week. Again, if you're just joining in, you're not familiar with the terminology I'm using, link below my top 5 favorite candlestick patterns. Free. 5-part video tutorial. Daily chart. Again, automated trend lines, time saver. Take them off, put them on. We had a failed breakout yesterday. We're threatening to break down yet again today. Volume rose above average today. I think you got to avoid NVIDIA, and it's setting up as a potential short on a breakdown below key support. The support level down here in green coincides with the support level at the 115 mark down here. And I wouldn't even buy it there. NBR, we'll leave it off with NBR, 702. Okay, I think it's going to 100. They do oil and gas drilling equipment in Texas. Do you think go all the way to 100 or maybe lower? All right, let's check it out. Again, we want to start with a macro view, that higher level view. We want to know where we've been to identify where we might be going. And I kind of like this chart. I don't like this month's price action. But here's what I'm looking at here. Is we had a nice long consolidation. We moved up higher, and then we dropped back down into a trading range. Now we're flirting with the lower band of support of a monthly triangle formation. Right now, you could argue that we're down below it. So could it go to $100 per share? Sure, absolutely. Last tick, 109.71. Here's a weekly view. We are firmly down below weekly support. So if we close down below this support level by the end of business tomorrow, the probability of us making new weekly lower lows is very, very high, making your price target of $100 per share very reasonable. Daily view. Yeah, I mean, this looks like it wants to go lower. Your next price target here is 103 on Neighbors Industry. Folks, thank you. Thank you from the bottom of my heart for being here. It's a pleasure to be here. I love the engagement with you folks. Please like, subscribe to the channel, and help support our sponsors. TrendSpider. We have a new sponsor I'm going to be announcing soon. We haven't inked that deal yet, but it's coming. Sure as God made green little apples, I hope. And we're going to be making some changes soon. And I think you're going to like it. So more to come, a lot happening behind the scenes here for the new year. I'm probably going to roll out pilots before the new year, and we'll do some testing for a new community that we're setting up for what we want to be is a bit more, how do you say, insulated from social media and their ability to demonetize and do things like that. So I'm changing things up a little bit to insulate myself. You're very welcome, Trish. Thanks for being here. Thank you very much. Franklin, thank you, sir, for being here. So anyway, our sponsor, TrendSpider, 35% discount code below. The Contrarian Trader, join our community. I have great members. They're intelligent, they're funny, and we always have a good time. So join up, 14-day free trial offer. Silver and gold level members get TrendSpider for free. Have an awesome night and a great weekend and a profitable trading day tomorrow. Be well.